Okay. Burner Market Trading Group. This is I can't wait for it. Today we are going over Bollinger Bands Part 2. And I'm going to cover a bullish curve and how price action and Bollinger Bands tell a story. I'm not going to go too much into the curve and completely confuse you, but I'm going to touch on it. I'm just going to kind of plant some seeds so that way maybe a little bit later on I'll do another series of these Bollinger Bands and I'll kind of tie it all in for you. But let's just jump right in. I'm going to show you how price action can tell you a story so that way you can kind of get a feel for what's going on in the market. When is a good time to get in? When's a good time to get out? And so here, I'm going to go ahead and mark the previous higher high. This is this typically means distribution in most cases. So if you see a higher high on the chart, wherever you're looking, that most likely is where institutional has dumped their shares, right? And you'll notice there's three drops as they dump their shares. One, two, three. And then it bottoms out right here, and you see the spike to a volume accumulation. That is absorption. And what is absorption? We covered that before, but that means that whatever was left in the float, all the shares that are being saturated into the float on this dump, they're picking them back up right here, and basically it's called soaking up the float. It's taking all those shares out of the market and tying them up so nobody else has them, but also at the same time driving up demand because there's only going to be a handful of shares left over for retail. That's me and you. And that's what causes price action to move up by itself without them having to create a lot of volume. And so that's called the free ride up. And so whenever you see a dip and price action drops and puts a candle outside of the Bollinger Bands, typically another candle will hit the bottom Bollinger Band. It'll move price action will move away from completely and come down right here and hit the bottom Bollinger Band. But in this scenario, what happened was they hit this high, they dumped their shares, they hit absorption. You get three bounces after absorption, and then it tries to make a move going up. And so if when price action goes and paints a candle outside of the Bollinger Band like this, go ahead and circle that, then typically you're going to get another candle touching the bottom Bollinger Band. But in this scenario, price action moves up and hits the top Bollinger Band instead. When you see that happen, that's a bullish move. And so immediately after hitting here, you can anticipate that price action is going to hit the bottom Bollinger Band again right after. And that's because when price action goes up here instead of coming down here, it's trying to drag that bottom Bollinger Band up. And so it drives that Bollinger Band up to follow with it, and so it reduces the amount of time it takes for it to come back down and touch the bottom Bollinger Band. And the reason why it does that is because it's setting itself up to go ahead and go for a higher high. And so price action drops outside here, should come down and jump here, but it doesn't. It goes up here and touches the top Bollinger Band, then immediately touches the bottom Bollinger Band. Now you're set up. This is called the spring. It's the final dip into liquidity. It's also called the spring. And so this dip means that they free up any other shares that people are thinking is going long right here, put their stop losses underneath this price action because they feel like they're safe. It drops down into this area, takes out those stop losses, free up those shares, buy those up, and now they have a larger portion of the float, which also drives the demand up even more because if you noticed, it was starting to wane right here and starting to come down. So this dip right here gets the last bit of liquidity that's out there, ties that up. Retail sees the price action moving back up because they just soaked it all up again. They jump in because of fear of missing out, and they ride up for free. And you see no volume right here at the bottom. And so based on the previous volume spikes and the volume accumulation spike to 100% right here, this means that this run is running out of steam. And so what they do is they sell off a portion of their shares. And anytime that they push down, the market naturally reacts going up. It's just a psychological thing that they do. They push down, they sell off, and then uh, retail, who's trying to get in, that's not able to get in because there's no more shares, is able to gobble up those shares, and that drives price, drives it back up. And so it shoots up here, and now they broke through a new high. And so I drew the last previous higher high right here, and so you can see they broke into a new higher high right here. And so this naturally is where they start to distribute again. And so that completes one curve on a in price action, and also completes a Wyckoff schematic, which is the same. Basically, they're kind of similar, but one is visual, one is more technical. Um, but both are satisfied at the exact same point right here, and that's where it created a new higher high off of this previous higher high. They dumped down here, picked up new shares, drove the price action up, started to wane, dropped it down, hit the bottom Bollinger Band, also freed up all the shares of everybody else who jumped in late, thinking that it was going up right here, but instead it started to wane right here. Got in, took out their stop losses on the way down as they dumped off some of their shares to get free, to get newer shares that are cheaper down here, which soaked up the float, which also created more demand, which drove the price up, which also created fear of missing out, which created another spike in price as it drove up. And then as it came up to here, started to wane again. They sold off another portion of their shares, gobbled them back up, and then also spurred in another frenzy of fear of missing out, which caused the price to jump up even higher. Now, at this point, there's a lot of selling off going on right at the top of this candle, and there's still a lot of buying coming in from people who are afraid that they're missing out on this move. And so as the buyers are coming in, they're neutralizing them, creating these indecisions here, neutralizing, 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 up until it goes flat. And then that means that is called the buyer's climax. That move is completely done once it goes flat. And then as they're selling off, becomes more red indecision versus green. That means that the retail is finally given up, and now institutional is outselling retail, who was out buying at one point, and now price action starts to drop. And so when this happens, that goes into a what we call a bearish curve, and that is for the next uh, you know next part of this series. So I'm going to tie it up there. Thank you for tuning in. If you got any questions, please put the comments down below. I'll be glad to answer them. Hopefully you learned something, and I will see you on the next one. This is I Can't Wait For It. Thanks again.